Let's talk fixed income and a new hunting ground for quants. With nearly $17 trillion of global debt already yielding below zero, investors are keen on new products for their money. According to Invesco's annual survey, 95% of institutional investors now say they think factor investing can be applied to the world of fixed income. Let's get more details with Sam Potter, who runs our ETF coverage from Bloomberg News. Sam, good morning. Look, factors are already really popular in the equity world. Tell us why this matters in terms of fixed income for the world of ETFs.
Good morning, Dani. Well, it matters for two key reasons. The first is how these large institutions, these big investors, choose to get their exposure. The second is the scale that we're talking about here. So also in this survey, we saw that there is a growing use of ETFs for these investors to deploy in fixed income and deploy factors as well. Most institutions now use factor ETFs, it found, and it said that 14% of their factor portfolios are in ETFs. For wholesale investors, it's more like 50% of their portfolios in ETFs. Now, in terms of scale, this is a survey of investors, of institutions with more than $25 trillion in play. So, as you can imagine, any growth there, any increase in allocations towards factor strategies in bonds is likely to find some of it at least, is going to find its way into ETFs. And that could lead to more of a boom into the smart beta fixed income funds.
Well, speaking of a boom in ETFs, the boom in bond ETFs in general, Sam, it seems to have gotten a lot of flack over the past couple weeks and months. A lot of research out there saying that the growth in them could be storing up trouble. What are some of these academics saying?
It's the fear that has always dogged bond ETFs, in fact. Simply put, they're taking not very liquid assets, like many bonds are, putting them in a very liquid wrapper, which is what an ETF is, causes a mismatch that can leave investors potentially trapped in any market shock. Now, fresh research from a PhD candidate in the Swiss Finance Institute has taken a look at this. And he wasn't looking for issues so much, but he did find that increased ETF ownership of a bond or passive ownership causes bond liquidity characteristics to be similar. So bonds behave the same way. And the upshot of that is, in a sell-off, in any kind of liquidity shock, more people could potentially be trapped in more assets.
Right. Sam, thank you so much. Our very own ETF czar for Bloomberg News. Thanks. And now we're back with Howie Li from Elgin. Howie, Sam talks about this dual concern of both crowding into bond ETFs and some of the liquidity issues. Are those concerns you also share about these products?
I probably don't share the concerns in the same way. We certainly get questions from investors. A lot of people think, ETFs won't be able to handle bonds. But actually, if you look back to what happened already this year, bond ETFs did exactly what they were supposed to do. They remained liquid. They remained tradable. Now, at that moment in time, around March and April time, spreads did widen. But actually, what people realized during that time was the spreads of the bonds widened just as the underlying bonds themselves widened. So the Bank of International Settlements actually came out and wrote a paper after doing some research to analyze what happened there. And they did highlight the fact that what bond ETFs did do is essentially reflect the pricing and gave it actually almost a leading indicator of bond pricing real time to investors. And so bond ETFs can continue to essentially give exposure to the underlying bonds in a diversified manner through a single trade. Now, that being said, I think it is a responsibility of issuers to make sure whatever they put into a bond ETF indeed remains liquid. So investment design is going to be very important.
But Howie, how attractive or how much does the story of attractiveness for bond ETFs depend on the Fed support?
I mean, the Fed support buying into bonds this year has obviously made a lot of headlines. Now, if you look at the scale of it, it's actually quite small compared to what's actually trading in the exchange. I think up until the end of September, the Fed had only reported to have bought about $9 billion worth of bond ETFs in the US. A lot of these were indeed US listed ETFs themselves. So technically, it's not really going to move the market. But what it does do is actually highlight to investors that this is an access route that is easy to invest and liquid and also diversified.